Today, why governments love building. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian and New Zealand flavour. Today I'm joined again by Joe Wilkes, our property expert. Hi, Joe.
Morning, Martin.
You all right?
Very well, very well. Yeah, lost my hair at the weekend over the cricket, but all good. That'll grow back hopefully. Although I think it demonstrated signs that I might not have long for hair in my life, but never mind.
No, well, it always amazes me because I have similar issues, although in a different part of my head. I have to pay the same as somebody with a full head of hair when I go to the to the place to get my hair cut. It should be proportionate.
It's funny. I went to hairdressers recently, and I said, "Is there any chance of a haircut? How much does it cost?" And the guy looked at me and he said, "Well, I'll tell you what, it's going to cost you $25, but I've cut all the other 10,000 for free."
Very good. So we're going to chat today about this whole idea of building and why governments love building, right? Because it's a fundamental driver to the economic activity, but it isn't necessarily without its traps, is it?
No, well, I thought we'd cover it. We had a look last week about the building issues that Vancouver are going through and the comparison to Auckland, which hit a record, 45-year record for consents in June. Let's sort of just have a discussion about building because it's such an intrinsic part of the economy. And a lot of people look at it and say, well, it's productive. And that's a real plus. It is productive. It gives people jobs. They're producing something. Houses is great. Building of infrastructure is great. The housing side is, I suppose, my area of expertise. And I just wanted to talk about why governments love it so much. It contributed a major part of GDP growth to New Zealand's first quarter's results, 0.8% growth in the construction sector. I've just had my daughter run in and out. You can grab some laughing cow cheese, yeah. Came in and stood right behind the camera. Right, Edie, Flo, can you disappear, darling? Take it with you. Take it with you and close the door. Thank you very much. Where was I? Just literally put a head over the top of the iPad. I just no way I could concentrate.
Reminds me of that video. I don't know whether you ever saw it. When there was an economist being interviewed on the main TV, and his daughter came in and got interrupted, and so and then the mother came in and grabbed it, and he saw them taking them both out.
Yeah, I was about to swear, but I thought probably better not on camera. If you want to put it in, I don't mind. We're normal people. And we're
no problem.
Returning to building. Building in the first quarter GDP results in New Zealand was the standout performer, and it's got largely because we've got consents at record high and people are going willy-nilly haywire because we've had high house prices over the last few years. Now, from a government perspective, and this is something that I want to talk about because you're going to see, we've already seen construction firms collapse in New Zealand. There were several last year. Ebert was a big one. There's another construction firm collapsed last week down in Christchurch, building a hotel. The costs spiraled, the debt got too big, it'll get written off, some subbies will go to ground, and probably the Phoenix company will arrive from the flames with the same directors, which I always find morally wrong, but it's the way of the building game. Unfortunately for the subbies, they're the ones that get left with the missed payments, the staff that they need to pay, and the emotional trauma of going through it. But governments do love building, and the reason for it is that building gives you what I would call the double whammy credit growth. It gives you the opportunity to grow credit through the construction phase. So the construction phase, particularly of housing, materials firms do very well. We've got two over here. Fletchers and Carter's real monopoly on the whole construction industry and product. And I don't know whether the barriers to entry are just so big or whether the barriers to entry are being protected by the government. You know, they're big taxpayers. Fletcher have had, in a building boom, they've had some fairly horrendous results over the last couple of years. They've had projects that they over promised in terms of their ability to bring in on cost, and they've suffered as a result. But the governments like building, and it's because after that credit growth and all the materials and all the construction products, they then get to sell a big mortgage to a young person who'll buy the house. The money then gets recycled into the economy, and off we go. And it's really interesting if you look historically, and I like looking back, because you can look back and you can see where things peak at various levels in the cycle. And I'll send over some data for you, but land prices tend to peak before property prices in these building cycles. Everything's going well. People pay more and more for land, and that tightens the margins on the production and then ultimately the profit. As the profit starts being affected on the new builds, the land that's banked, and we've got no shortage of land in New Zealand, there's loads and loads of it. The land prices then come down, because otherwise the builders, there's no point in them buying it, because they'll lose on the end product, particularly if prices aren't getting them out of it by rising 4 or 5% every year. If they're flat or if they're falling, that tightens the margins. Now, if you look back at the UK experience, our housing bust led our recession, and then we had the GFC. Share prices of firms that are land bankers, British Land Corporation, for example, FTSE listed, they peaked back in 2006. A lot of the house builders, Persimmon, Bovis Homes, Red Row, their share prices peaked later, early 2007, before we started seeing prices come down. So I would say in the UK, the top of the market was probably March, April 2007. We saw a slowdown over the summer. Very quickly, Northern Rock got into trouble, and the run on the bank in the August of 2007. They were largely relying on offshore funding for their mortgage loan book, and that's very different to how a lot of banks are funding. I think there's less exposure to that type of funding today. But with the actual share prices of the builders, they then dropped off, and they fell from 2008, 9, 10, 11. And what happens then is that the governments look at it all and they think, shit, we're not building enough because people can't build. They bought land at too much. We're not going to build it because we can't make a profit. So we've bought this land. We're stuck with it. We just won't build. But that slows down credit growth. So if people aren't building, you don't get that double whammy credit growth from the construction side and also from the end user. So what you'll find next, and this is the way that I would see Australia going, is that you're going to see building firms going under, and it's already happening. I did read somewhere that there were 100 or so that had gone over the last couple of months. You probably got more information on that than me. But as these building firms go under, land prices will start to fall. There will be some who will be able to offload land to try and keep other projects going, because the money's not in the land. You can't sell a piece of land in a market where nobody wants it, but you can sell a house for somebody to live in. So there will be some who will offload land, and they'll offload it cheap to go and keep the businesses going, and they'll reduce their land backs. There'll be some clever buggers out there who've spotted this, and they're largely sat on cash, and they will chop the balls off those that need to offload land. Now, in the UK, so much of the development is done by private companies. It's big private companies, and that's different to here. We've got a few major builders, but we're far more exposed to the mum and dads who've gone and remortgaged the house, gone and bought a parcel of land, and like we talked about in our other posts, they've gone and built a home to retire to in Tauranga, or they've bought a bit of land where they're going to build a house where they fancy retiring, or they're just going to build something that they might look at renting out. And this is where the pressure is going to be very, very different in New Zealand. Now, when you go through these credit changes, what I think you'll find is that the government will come up with even more creative ways of getting units sold, because there's a double whammy on the credit growth. You've got your first-time buyer incentives kicking in Australia early next year. We have first-time buyer grants over here in New Zealand, although they are a piddly amount relative to the purchase price of a house. Now, in the UK, we got incredibly generous. So by 2013, building, the building market was on its knees. The share prices of the major builders was on the floor. And this was affecting returns to pension funds and therefore dividend payments to pension funds and everything else. So the government said, right, we've got to get some activity into this sector. And that's when we started to get very, very generous first home buyer grants, equity schemes, so shared equity schemes. And you're going to have exactly the same thing happen, I think. I can't see any other way that you're going to get out of it. So if you look back at the UK, in April 2013, we had the introduction of the government-backed equity loan. So first-time buyer only needed to come up with a 5% deposit, and the government would then give them an interest-free loan, crazy, for 20% of the purchase price, topping them up to 25%, which would allow them to go and buy an overvalued house, which without it would have been 25% less, probably. You look at the share prices of the stocks that I'll send over to you, and just look at how those share prices started to ratchet up immediately that this scheme came in. So from 2013 onwards, these schemes started going haywire. What's interesting again for the UK perspective is that British Land, their share price started falling in 2015. Possible leading indicator, nothing to do with Brexit. Their share price started falling before Brexit happened. And you're starting to get the screaming from the builders about, we want these first home buyer guarantees extended beyond the current 2021, which is when they're meant to end. But that wasn't enough in the UK, so we got even more creative. And then we introduced, because London was really, really suffering, massive bubble in property prices. And for those that want to know, the top end of London is falling. The lower end has gone up over the last few years and stayed stable. If you go to many of the affluent suburbs, prices at the top end of the market peaked back in 2014 and have been falling now for 5 years. It's about 20% off the top end. The overall price growth is all being manipulated. I'm going to say manipulated because that's all it is, by the government and by these schemes to get the lower end market ticking over, the double whammy. Now, in London now, the shared equity schemes, you only have to put down 5% on a house up to £600,000. So we're not talking, we're not talking buttons. We've got an average wage in the UK of about £27,000. So we're talking a lot of money. But what they'll do is they'll top up with a non-interest loan of 40% to provide that.
Did you say 40? 40?
Yeah.
Oh, you're kidding me.
No, I'm not. So 40% to prop up the flats that they're selling for 600. Interest only. Kids are getting suckered into this because after 5 years, the interest rate that many are charged on this is actually beyond what you get from a bank deposit. If they're sensible enough, they'll use that interest-free period to chunk that down. But without it, and if the scheme comes to an end, where's the market to replace it? Because it is only this that's happening. Now, from a overall market perspective, it's shit because the money goes into the new builds. New builds, they're not buying another house, so there's no trade up of the cash. So it just gets in there. It gives the government the double whammy, but it doesn't help the wider housing market, which is still suffering, and transactions are starting to, have been falling quite consistently over the course of this year. So what creative enterprise will they come up with in New Zealand? I don't know, because it's different, because so much of our exposure is for the Ma and Pa's, and the Ma and Pa's aren't building dozens of houses. They might be building one or two. Will this shared equity scheme go in? The other thing that you're going to find a lot of is the builders offering shared equity. So the builders will retain an equity position in the house. In the UK, it's not uncommon for this to be 25%. So if a buyer's buying and isn't a first-time buyer and doesn't get this government-backed guarantee, the builders will take a position of 25% of the equity agreed at your original purchase price. The risks here for a first-time buyer, I want to talk about the risks of first-time buyers, they're the ones I care about the most. But the risks of first-time buyers is that prices fall, your equity gets damaged first, theirs gets protected, and it has to fall a long way before they don't get their money back. What it allows the developers to do is to take value off the books, keep the businesses going, and provide a really nice buffer for future cash flow as and when you choose to pay it back. That's what happened in places like Dubai, places like Spain. It's going to happen in Australia. It's going to happen in New Zealand because we're just 10 years behind what everyone else has done. The final thing you're going to see is wonderful incentives from the developers because they won't want to reduce their whole, 30 blocks of, so it's 30 apartments. They won't want to reduce them publicly. The minute you've done that, you've undermined everything. So what they'll do is they'll offer very, very generous schemes for landlords where they will guarantee the rent. So they'll guarantee the rent at a rate that you won't get from the bank, and it'll be for a 2-year period. After which time you realise that the real market rent is completely different to actually what you've been guaranteed. And over 2 years, you've not paid anything back really off the capital. If you're lucky, you paid 2 or 3%. But all of a sudden, your yield will just hammer down. It's a wonderful way to sell stuff because people are only thinking the next 2 years and not thinking about the next 30. So just be mindful, you're going to see that. So investors are going to be lured into the market with these wonderful rent guarantees. I have heard of rent guarantees in some parts of Europe where the rent guarantees were like 12, 13% because the margins are so big on the development projects that it's just, they could give it away, providing they weren't having to give it away all off the price in the first instance. Those rent guarantees are phenomenal.
Yeah, and all of that, of course, supports the initial high home price, right? So the illusion is that the property market is doing well and home prices are fine, but below it, below the waterline, as it were, all of these things are actually happening, and they're all artificial. So essentially, this is not a free market operation at all. This is essentially a market that's being manipulated and controlled. And the trouble is that the end borrower and buyer, at the end of the day, is taking so much of the risk, isn't it?
Yeah, I mean, the guys who are running these major construction firms in the UK, they have been remunerated phenomenally based on the performances of their businesses. The dividend payment has gone up. The dividends support the pension firms, so that it's a win-win there. But ultimately, there are a few people who've earned an awful lot of money off a government scheme, and there's still an awful lot of risk in the system because we're now starting to see, because you've got to think, this came in 2013, we're now starting to see the stresses build up in the UK market. Ignore Brexit. Everybody's talking about Brexit. The UK's issue with housing has nothing to do with Brexit. It's to do with our debt bubble still. So we've now got these kids coming off their 5-year term, end of 2018-19. All of a sudden, things are tighter. They're having to refinance in the real market, and their costs are going up, and it's uncomfortable. So anything that sounds too good to be true generally is too good to be true. And just factor in that at some point, if you've got all the money sat in the bank and you're earning the return on it, that's fine, and that's interest-free money. But if you're not, don't be fooled into these things.
It's very good advice, Joe. Thank you for that. And once again, people need to understand the internal dynamics of the way these markets are working, the fact that the government has an interest in turning and churning and trying to actually keep the economic momentum going. Builders precisely the same. But at the end of the day, the risks are being taken by real people who are making investment decisions perhaps without full information. So you've been warned.
Yeah, well, we've just highlighted a little bit of how the bubble can be continued and some of the actions that are on the table for the government to look at continuing the credit growth. And in the New Zealand market, we probably have fewer big developers than you do in Australia. So the weight of this and how would they put a scheme together to help the small mum and dads, that is the big unknown. Will they help the small mum and dads, or will they purely grant overseas investment exemption to the big boys, and the mums and dads get left on their own to try and brave what's coming? At the moment, we haven't had in New Zealand the big granting of incentives, but there are, and again, somebody who is contributing information. There have been instances already in New Zealand with the developers themselves, and there are a couple of firms who are actually advertising shared equity as an option, as a purchase to option. I came across one chap who he took on a shared equity mortgage with the developer a couple of years ago. The developer retained 40% of the interest and has a second charge on the property. He's lost his job. The guy's in his mid-50s. He's got 4 kids. He thought it was a wonderful option because it's cheaper than renting. Thankfully, he's in a part of the country where prices have gone up a bit. But imagine if he'd been in some of those suburbs in the North Shore where, you know, we're seeing and we're hearing about people who bought in 2016 taking haircuts of 10, 11, 12% on their purchase price. He'd be in a very, very different boat. So warning, you know, buyer beware, and think for 25, 30 years, don't think for the next 2.
Good advice, Joe. Thanks once again.
Cheers, Martin. Take care.
See ya.